do here, okay, so we've done the heavy lifting for today, at least. See something? Am I recording? Okay, happiness there. So now we want to get into Unit 4. Okay, so the next time I see you, which is online, yes, online. What just happened? Wow. Okay. Yeah, next time when I see you, which is online, we're gonna hop straight into exercises for Unit 4. Okay. I think I'll see you on Thursday and on Friday. Okay. So we're doing financial statements. Okay, and this unit again is very closely related to your Unit 3. Okay, so please make sure you're comfortable there. Otherwise, here things might get yeah. I'll let you finish it off. Income statement. This is more of a recap. Income statement is really just about assessing your financial performance for a specific period. Balance sheet, assessing your financial position. Okay. The question now arises whether these statements are indeed accurate. Now, why wouldn't these statements be accurate? Some may be wondering. Okay. The purpose of performing year-end adjustments is to ensure that the financial results are accurate and realistic. Okay. The most important year-end adjustments. Okay, depreciation, we played around with that. Okay. We know that we only calculate depreciation at year-end unless we are disposing of an asset prior to year-end. All right. Then we have accrued expenses. Callum, I know you were crying for this last semester, so prepaid expenses, income received in advance, accrued income, consumable stores on hand, impairments of inventory, and then allowance for credit losses, all of which we're going to talk to a little more as we go through these slides. Okay. Now, in addition to the above adjustments, several additional transactions can occur at year end. For example, before creating allowance for credit losses, all right, the business might want to write off actual credit losses first, because there is no purpose in creating a provision on something that has effectively happened already. Okay. So now some of you might be wondering, allowance for credit losses, what's the difference? I'll explain it to you now. Let's just finish this. In addition to that, year-end also involves searching for bookkeeping or accounting errors which must be corrected when found. Okay, so let me start over here. So the difference between credit losses and allowance for credit losses is simply this. Credit losses is when it has actually happened. Okay, he owed the business 5,000, isn't going to pay, he's gone bankrupt or been sequestrated, etc, etc. We're not going to get the money back. So that's a credit loss, or that's bad debt. All right, we played around with that. Okay. Now, provision or allowance for credit losses is now where we're saying we typically have sell 5,000. Sorry, let me go 5 million. All right, a year. All right, in credit sales. That's typically what we manage to sell. All right, but we know for a fact not everybody's going to pay us. All right, some are going to skip the country, some are going to go broke, etc, etc. Some people just won't pay. Okay, so we know that about 500,000 we're just going to not recover. Okay, so we make a provision for that so as to make our books more realistic. Does that make sense? Okay, so we bring the numbers slightly down as a result of that. Okay, then I just want to explain one more thing before I take your hand. I hope you still have your question. Oh, all right, cool. Now, we were speaking earlier to why are the books not accurate, or why are they not realistic? It's because of those type of things, right? and we'll speak more to it as we go on through the next slides, but because of accrued expenses or accrued income or income received in advance, we're only concerned with this particular financial year. But you'll find that although I sold to a debtor in this financial year, they only pay me next year. Can you see that? So even though they're only paying me next year because I've received that income in this financial year, or should I say I'm entitled to that income in this financial year, I want that we, accounting people, want it in this financial year, even though we only receive it later. Does that make sense? And it's the same thing with expenses. Okay? Right. So let's go on. Also, errors would make it our books not accurate. So errors are corrected in the general journal, this we know, along with recording all the other adjustments. All right. Remember, we can't record all these adjustments in the other journals. They are recorded in the general journal. Essentially, any type of adjustment or transaction should be taken into account if it is material to the interpretation of the financial statements by stakeholders. So in other words, anything that would impact or influence our decision as stakeholders, all right, management, owners, all right, employees, whether I sign with your company or not, right, whether I stay with the company or not, etc., etc. Anything that would influence those type of decisions, it needs to be accounted for in the financial statements, okay? So that's why we do this year-end procedures, why we do all these adjustments, and so forth, so forth. Depreciation, we're well aware of what depreciation is all about. It's about making sure that our assets have a realistic trade value. In other words, current value. Okay, so we know, okay, we've had these tables, let's just say they're worth 800 Rand when we bought them, that was the cost, but you guys have been busy drawing nice little hearts and of you and Bay and all those types of things, scratching the tables, etc., etc. We've had them for 4 years, they're obviously not going to go for 400. Does that make sense? So we want to make that realistic, okay? Therefore, the purpose of depreciation is to adjust the cost price of non-current assets downwards. Now again, remember, not all assets depreciate. Some actually appreciate, okay? So things like land and buildings you saw in the PPE that we did, it didn't actually lose value, all right? It was just 400 the whole time, 400,000 the whole time, okay? Typically, they would actually appreciate. Other examples, antiques, vintage cars, believe it or not, okay? Those are things that appreciate in value, okay? Right. Then the accrual concept, and I was speaking a bit to this now, right? This concept stipulates that all expenses and income must be assigned to the financial period in which they were incurred or earned, all right? Which is what I was talking to in terms of the financial year that we're interested in. Therefore, when profit for performance is determined, it is not important when the particular expense is paid, all right, but when it is incurred, all right? So in other words, when do I owe the rent? If it's in this financial period, we want to include it in the rent line, okay? But if it's next year, we're not going to include it in this financial information. Sorry?
When you put that information when you're not going to track it now, but you need it for the next time, so you don't lose it.
So again, remember, that's where we would then make the necessary adjustments. So that is actually a very good question. Typically, I think you would put it in the notes to say, because you will have, for example, another situation that you may have is that we paid for rent, not only for this year, but for 6 months after this year. That money has left us, all right? But in our books, we're going to adjust that amount to only include the 12 months that was paid, because we only want to look at the rent expense for this financial year. Does it make sense? So, yeah.
It's only important for when
it's only important for the next year. And then next year, we're going to say, okay, what was the actual rent expense that was incurred for this year? All right. So going further, it is not important when the actual income is received, but when it is earned. Okay. So he owes me 5,000 in this financial year. He hasn't paid me. He's only going to pay me January the next year, all right, or March the next year, right? But I'm still going to record that sale and the fact that he's a debtor in this financial year because it is earned, it is owed to me. Does it make sense? Okay? Right. Now, now we begin to really break down these things that we haven't seen before. All right? Accounts that will be created at the end of the financial year to apply to the accrual concept. Okay, so accrued expense. Guys, I don't want you to cram this stuff. I want you to just know. Okay? And it's very simple. Okay, it's not something you need to cram. Accrued, whenever we say accrued, all we're saying is that it is something that is owed. So when we say accrued expense, obviously remember we're always talking in relation to the business. All right, so we're saying it's an expense that we owe. Does that make sense? Okay, so we know that when we owe something that is due within 12 months, it becomes what? A current liability. So accrued expense is a current liability. Okay, so please take note of that. Okay, this slide is one of those that's worth actually taking a picture. Okay, because the things that we see, it shows us that no, this person doesn't understand what is a prepaid expense. Prepaid expense. Why is a prepaid expense an asset? Somebody tell me.
Because we're already dealt with that expense. We don't have to worry about it next month because we've already paid.
Yes, that's true. We don't need to worry about it because we paid in advance, right? It's kind of like when you buy your airtime. You know that the airtime is in the phone. You don't need to worry about buying more airtime. Just pick up the phone and call whoever you want to call, right? But why is it an asset? Yes, we don't need to worry about it. Why is it an asset? Yes. Accrued income. Nope. Oh, sorry. Prepaid expense. Nope, it's not. Because remember, it's an asset. I like where you're going. I agree with that. It's ours, right? We're entitled to it, right? Yeah. Yes?
So is it that we can only give it back? Since we paid in advance.
Yes.
We can only give it back.
So the money hasn't been like
Mhm.
spent properly on the product.
So I see where you're going. You actually are right. You can cancel the thing and get it back. So yeah, that's another direction you can take. So you're 100% right. 100% right. How I like to think of it is I'm owed a service. Does that make sense?
Like creditors.
So they're creditors to me. Does that make debtors actually?
Oh, yes, sorry.
They're debtors to the business.
We credit the other way around.
Yes, we are creditors to them.
So when we prepay expenses in the other business books, is that income received in advance?
Yes, that income received in advance for them. Yeah. Yeah. Right, but I don't want to get too technical because I know I'm going to end up losing someone. The whole point is that something is owed to us when we have a prepaid expense. Okay? And like she said as well, I want to include that because you're 100% right. And we can cancel this at any point in time, and then we obviously have a refund that is due to us. Right? So, right, that's prepaid expenses. Okay, then you have accrued income. Okay. Again, this is money that is owed to us. Okay, he didn't pay in the financial year he was supposed to pay, but it doesn't mean that I'm not entitled to what he owed. Okay, we've earned that income. I've given him the service or the product, but he just hasn't paid it. That's accrued income. Then income received in advance. Why is this thing a current liability? You haven't done the job. We owe someone either a product or a service. Does that make sense? Okay, right. All right, so this is why I'm saying I don't want you guys to try and cram this stuff. I need you to just understand it. Okay, right? Because also if you try to cram it, when we start to make you apply this stuff, that's when we see they actually don't know. They're not actually sure about what this is all about. Okay, the accrual basis of accounting is applied to all financial statements except the statement of cash flows. And why is that the case? Because cash flows is money going out, money coming in. So there's no space for you to be recording what we owe to whoever else or what is owed to us. Make sense? Okay. Right. Then credit losses, something we're familiar with. We've recorded this, okay, when we were doing Unit 7, we played around with credit losses. I think we also played around with credit losses elsewhere. In the general journal, we played with the general journal as well. Also recorded credit losses, okay? So now they're also talking to the provision, all right? And remember what I said, the provision is just us saying, we anticipate, we're not going to get 5 million worth of credit sales. We know this. Some people are not going to pay us back. So let's just create the provision so that when we look at our financials, it's realistic. We're not saying we're going to make profit of 20 million when we know, nah, there's that 500,000 that we know is we're not gonna realize. Okay. Remember, the objective is realistic and accurate. Okay. Right. In the same way as provision for depreciation, that's just another name for accumulated depreciation, decreases the potential inflow of cash from the non-current asset. Allowance for credit losses thus falls in the same category, right? Why does it fall in the same category? Because it's also a negative asset, okay? Allowance for credit losses is a negative asset. So in other words, whenever we increase our provision for credit losses, we are going to credit allowance for credit losses, okay? If ever we want to reduce that provision, we're going to debit allowance for credit losses, okay? All right, and we'll speak a little bit more to that now, okay? So when we first create the provision, when we first get to the realization that, you know what, we're not going to realize this 5 million. There's a 500,000 that we know is not going to, they're not going to pay us back. When we now want to create that provision, we say allowance for credit losses adjustment. That is an expense account, okay? Allowance for credit losses adjustment. That is an expense account. So we're going to debit that because remember, expenses, we debit, okay? Then allowance for credit losses, that is the negative asset. Notice the difference. One has adjustment at the end of it, and the other is just allowance for credit losses. Makes sense? So allowance for credit losses, that's that negative asset. Allowance for credit losses adjustment, that is their expense. Okay. Now, so yeah, as I said, when you're first creating it, you're going to debit allowance for credit losses adjustment, and then you're going to credit allowance for credit losses, the negative asset. Okay. Now, in the following year, right, after we've created this provision, we might say, you know what, our debtors have actually been doing a great job in paying us back. So we actually don't think we're going to make a 500,000 loss, all right? We think it's actually about 250,000 that we're going to lose. So can you see now we're adjusting that provision, okay? So now when adjusting the provision, what we then do is we say, this expense that we thought is 500,000 is actually 250. Can you see, in order to reverse that expense, we actually now need to credit. So we're going to credit allowance for credit losses adjustment, okay? And in that instance, it's actually seen as an income. Does that make sense? Because we're adjusting that expense, okay? If it's not sinking right now, don't worry. When we do exercises, it will make sense, okay? And so if we're crediting allowance for credit losses adjustment, that means that we are then debiting allowance for credit losses, the negative asset. Does that make sense? Now, here's the other thing. We might actually be adjusting downwards. We might actually be saying, you know what? This year is even worse than last year. We anticipate that we're going to have a 750,000 loss in terms of people paying us back as debtors. Okay? So now we need to adjust this allowance downwards. Does that make sense? So what are we going to do? Somebody tell me.
The opposite of what you just said.
Exactly that. Okay. So we're going to debit allowance for credit losses adjustment, okay, by that 250 extra. Okay. And then we're also going to then credit allowance for credit losses, the negative asset, okay, like we did initially. Okay. So that's all they're speaking to on this slide.
So does a negative asset increase like a little asset or opposite?
It's the opposite. That's why we call it a negative asset. Okay? It's the opposite. Cool. Right. No questions. We can proceed.
So can you say like depreciation is
100% it is. It is. Those two are the same in that they increase on the credit side, decrease on the debit side. 100%. Okay. Then we have the post-adjustment trial balance. Okay, this you've seen from 1A. What is the post-adjustment trial balance? This is basically the trial balance before we take into account any errors the bookkeeper might have made, any accruals that need to take place, okay, closing transfers, all that stuff. Before all of that stuff has happened, we know we have our post-adjustment trial balance. Okay. Wait.
Isn't it pre-adjustment? So
That's where my mind was actually. It's a pre-adjustment trial balance. Post is after we've actually done that. My bad, guys. Sorry. Okay. So now here they're just talking to the closing off of accounts where we're doing all this stuff. So you can only close off your accounts after you've done all these adjustments, done all these amendments of errors, so forth, so forth. Yeah. Right. Then here they're just speaking to the fact that after you've done all these adjustments and corrections and errors and you've closed off the books, your capital account now reflects the owner's equity. In that capital, you've added your profit to your capital, and you've obviously deducted your drawings. Okay. If we made a loss, this would actually be a deduction, a minus. Okay, our capital would actually be decreasing. That was the result thereof. The capital account in the general ledger reflects the same movements recorded in the statement of changes in equity. This, in a nutshell, is your statement of changes in equity. Okay. Let's move on. Okay. Now, in Unit 4, you guys need to be familiar with these statements. When we are doing exercises will actually just be focusing on the adjustments and the errors and whatever else needs to be done. After we now know what needs to be done, you then will have to adjust or rectify those things in these statements. Does that make sense? So there's no time for us to, if you're not familiar with these things, please make sure you go and have a look at these. The pages might be slightly different, but they are there in your textbook. Okay, so just check a few pages forward, and you should find those statements. Okay, right. Then the last thing that we want to touch on, I think it is the last thing, maybe second last thing, is that your periodic inventory system. For your income statement, your income statement is not going to be the same on the perpetual inventory system and on the periodic inventory system. Reason being is, remember, under the periodic we don't have cost of sales. So now, when you're now doing the income statement for the periodic inventory system, you're going to need to calculate your cost of sales. And who remembers the calculation for cost of sales? Yeah, you're there, but in another section of the word. Let me just give him a chance.
cost of sales, the one is the opening balance.
There we go. So opening balance, yes. then plus your purchases, minus your purchases returns, plus any, remember the expenses that you would incur to get the inventory ready on the shelf, so like import tariffs, transport duties, that type of stuff. You're adding that in, and then minus your closing inventory. All right, that's the formula. So what would then happen is that in your income statement, and you can see this in my textbook in 2019, it's on page 136. You'll see that you'll then have your sales or your revenue, and then you would then have your cost of sales calculation before you can get to gross profit. Okay? Some of you, I'm sure, have seen this in high school or whatever. Okay, so that's the first difference. Okay, then here they're also just highlighting any impairments. In other words, any shortfalls. Remember, when it comes to the periodic inventory system, what we are saying is we don't know how much stock we have until we go to the storeroom and do a physical stock take. Okay? So, in our books, we might assume, under the perpetual at least, we'll assume we have 12,000 words. And then when we do a stock take, then we realize maybe we have 10. Okay? So whatever shortfall that we now incur gets posted to the cost of sales. Okay? And that's all that they're highlighting over there. Okay? Then moving on, third difference, remember all those, as I was saying, carriage, ferrage, railage on purchases, custom duties, all of these things now need to be incorporated in that cost of sales calculation. Under the perpetual, we wouldn't need to do this because we know that in the inventory, the trading inventory account, all right, all these things would already be included. Okay? So therefore, because they're already included in the trading inventory, whenever we now sell the trading inventory, we know that those costs will then get posted to cost of sales. Okay? So we don't need to worry about that under the perpetual, but under the periodic, we need to actually do that there. Okay? Then, fourth difference. As a result of the above differences, the income statement under the periodic inventory system will always differ from that of the perpetual. Okay, so they're just repeating what we already know. Okay. Last slide. Trading inventory will be disclosed as the value according to stock take. Okay. Yeah. Because remember, we aren't recording trading inventory as we go along under the periodic, then under the perpetual, but the perpetual, yes, we're constantly checking. Okay, the statement of changes in equity and balance sheet will be exactly the same. Yeah. Right. Any questions or thoughts?
So what would you say the best way to get rid of accounting is?
To get rid of accounting?
Good.
Good at accounting. I feel like you already know this though.
No, but I mean in the sense that, like, how do we know what exercises to do and
Mhm.
etc. You know what I mean? Because there's like 300 in the book,
Mhm.
but only like 30 of them could be helpful.
Yeah, so my recommendation there is don't focus on doing the same exercises. Focus on different exercises
So
within the same unit. Because as you guys will have noticed,
it's the same questions with different values.
sorry?
It's like the same questions just with different values.
Just with different values. So you're just practicing, but you're not getting good with the topic and understanding how the different ways they can ask you the questions in relation to that topic. So for instance, with depreciation, some classes, and now I know I have entrepreneurship group in here and I have group 1 in here, okay? Some classes I did 3.7, other classes I did 3.8. Those two are the same. 3.9, 3.10, they're the same. So what I would have done is to do the different exercises. All of it, yes, is on the YouTube channel. But then, yeah, you want to focus on different exercises so you're being tested in a different way. Okay? Right, guys.